It is time now, once again, for another exciting round of Patreon questions and answers, where my Patreons ask the questions and I provide the answers, or at least attempt to. And I'm answering these questions based on my 27 years of experience investing in the market and my years of study through Minervini Private Access, studying David Ryan, Stan Weinstein, William O'Neill, etc. But I am not a financial analyst or money manager, so this is not investment advice. This is just for education, and if you have a question you'd like me to answer, consider joining my Patreon. Links in the description below. And we are going to talk about how to gauge market breadth, something that's really important because a rising tide lifts all boats, and vice versa. And we're going to talk about what fundamentals I look at. There's not many, but there are a few. We're going to look at some head and shoulders patterns. That'll be fun. I always like to do pattern recognition. And talk about some individual stocks. We'll see where that gets us. Without further ado, let's get to the questions. Okay, so my Patreon friend Miko asks, could you go over if there's some great tools to look for market breadth and how we could prepare every day to expect more of a bullish, bearish, neutral day other than stocks over the 200-day moving average, stocks over the 50-day moving average? I liked your post about MarketSmith advancers, decliners, but what if you don't have MarketSmith? So this is a kind of a complicated question, and I do have a great resource for you that you might be able to use. This is something, but first let's look at it a little bit on a broader level. This is something that I am believing in more and more. The longer I do this, the more I've realized that so much of the movement of stocks depends on the overall market direction. The old saw, the rising tide lifts all boats, is really true, and the converse is really true too. You know, they talk so much about diversification for safety, but in a falling market, almost every stock goes down, almost every one. So we really need to have our finger on the pulse of the market. The problem is the indexes don't give us an accurate depiction. You see, the indexes are not weighted, the stocks aren't weighted equally. I was just looking at a little research here on Investopedia. So the NASDAQ is comprised of 2,500 stocks, but they don't have, the index is not a depiction of those stocks. They aren't weighted equally. That's what I'm trying to say. And just to take a quick glance here, for example, Apple, 14% of the NASDAQ's movement is based on what Apple does. 11% of the NASDAQ's movement is based on what Microsoft does. 6% on NVIDIA, 6% on Amazon, 5% on NVIDIA, etc. So you have, I cannot remember the exact statistic, but something like 25% of the NASDAQ stocks equal 40% of the movement, or something like that. So just because the NASDAQ is going up, that doesn't mean the market is healthy. And just because the NASDAQ is going down, it doesn't mean the market is unhealthy. And the same is true for the S&P 500. So as Miko pointed out, one thing that I really like to do is look at the number of stocks above their 200-day moving averages. So when a stock is above its 200-day moving average, that signifies it's in an uptrend. So in a healthy market, we want to see most of the stocks in uptrends. So looking at this NASDAQ wiggly worm here, only 34% of NASDAQ stocks are above their 200-day moving averages. That tells us that it's an unhealthy market. And when the market runs up and there are so many stocks below their 200 days, that's kind of a divergence, and that's going to lead to, it's a very narrow market, and it's kind of like a Jenga tower. one little pull on one Jenga block, and it all comes tumbling down. So here's the NASDAQ's 200-day moving average. So if most of the NASDAQ stocks are below their 200 days, then we don't want the NASDAQ way above its 200-day. So we need the NASDAQ to come in, and we need the percentage of stocks above their 200 days to come up. We need these to correlate. Okay, so that's complicated. But so this is what you want to look at when the NASDAQ when an index is running up. What percentage of stocks are in uptrend? So that's one thing I watch. Now, another thing you can look at, like Miko pointed out, was if you subscribe to MarketSmith, it gives you a little breakdown every day. Let me show you. And by the way, if you want to see how to put this on your stockcharts.com charts, just let me know. I can do a separate video. It's complicated. Took me a while to figure it out. Now, if you subscribe to MarketSmith, one thing you can look at is this handy dandy little stock action bulletin. So today was a pretty heavy down day, right? And this kind of shows us more under the hood. Only 58 stocks were up on big volume, and 254 stocks were down on big volume. That's the exact opposite of the ratio we want to see. 0 stocks were breaking out, and only 5 stocks were near pivots. So when on a big up day, we want to see a bunch of stocks up on volume, not just a narrow handful, and which we didn't see today. Conversely, let's say we've had a series of down days, but the ratio of up on volume to down on volume is pretty equal. Then that shows us that the market is improving beneath the surface. Now, finally, Miko, 5 minutes later, I'm going to answer your question. What if you don't have access to MarketSmith? I check this, I glance at this every day. And what if you can't pull up this little wiggly worm on stockcharts.com? Then I bet you can go to your brokerage. My brokerage is E-Trade. If I go to Markets and Ideas, and then you click on it, which I already did, and then if you go to Market Statistics, every day it will show you advancers versus decliners. So what's not so important, the direction of the index is not as important unless you are long or short the index. What is important is how many stocks are going up versus how many stocks are going down, and what's the volume. So today, as you know, ugly red day. Here's a big bearish engulfing day. So we had 1,200 stocks advance in the NASDAQ. 3,000 and some declined in the NASDAQ. The ratio was almost 3 to 1. Only 48 highs, 225 lows, and up volume was 852 million. Down volume was 3.6 billion. So this was a bloody bearish day, and that was reflected in the market. But what we want to see when we get closer, assuming the NASDAQ comes down to this 200-day, even if the index keeps going down, we want to see these ratios equal out. Because what may happen is Meta, Nvidia, Apple, Amazon, they led they were the leaders in the first half of the year. They're going to come in, they might come in hard, but then the majority of stocks beneath the surface might start basing and start coming up. And so the market might be much better than the indexes are reflecting. And that's what we want to watch for. I hope that made some sense to you. So yeah, if you have E-Trade, do what I just said. You can look at it every day or every few days. And if you don't have E-Trade, your broker probably does the same thing. Let's move to the next question. Okay, Matt Martin asks, it would be awesome if you could talk a little bit about what fundamentals you look at if you find a chart you like. All right, so I started out as a rookie value investor. I studied the Motley Fool stuff. I learned how to read balance sheets, accounts payable, accounts receivable, all of that boring stuff. And I I don't do all that stuff anymore, and we'll get to that. But let me think a minute. I think the majority of people look at the numbers, the fundamentals, and buy stocks based on fundamentals regardless of the chart. Or they find stocks with really good companies with really good fundamentals, and then they wait for the charts to set up. And that's better than the former. But what Minervini does and what I do, and which is so much more efficient, is you identify stocks by strong charts, look at the relative strength and, the patterns and so forth. And then when you find a strong chart, then you look at the fundamentals, and that will tell you, is this something I just want to swing trade for 10%? Or is this something that has the potential to be an enduring winner because of its really strong fundamentals? Now let's get to the fundamentals that I look at, and then I'll show you one other resource I use to do fundamental research on stocks I'm planning to hold a long time, like Tesla or Lilly or Pepsi, Costco, some of those types of stock. Okay, Matt, so I keep it really simple. Once I identify a strong stock, like NVIDIA here, I look at 3 values and plus maybe a fourth. But you got to remember, stocks top when their fundamentals look the best. So even though NVIDIA has killer fundamentals right now, it might be topping out at least for the next few weeks or months. So I just look at 3 things. I look at earnings per share acceleration. Basically, if the earnings per share goes up long term, the stock will go up long term and vice versa. So I look at an increase in quarterly earnings each 3 or 4 in a row, preferably. The bigger percentage increase, the better, of course. But small caps are going to grow bigger than large caps. In this case, NVIDIA, the last 3 quarters, -33, -20, +429. That's great acceleration, right? And this is straight out of O'Neill's playbook, William O'Neill, the late William O'Neill, rest in peace. The next one is sales, -21%, -13, +101. Again, huge sales acceleration. Now, supposedly it's easier for companies to manipulate EPS than it is to manipulate sales. So keep that in mind. But also, in the end, what drives stocks is earnings per share. Then the last one is margins. And I look at gross margins, but you could look at a different margin type if you want to. In this case, +54, +63, +65. Again, those are really great. Then the last thing I like to look at, and I just use MarketSmith for this. The last thing I like to look at, there's a couple of other things. One, I like to look at a breakout year. See how this jumped from 3.3 annual EPS to 9.60 estimated EPS. When you see a huge annual earnings per share jump, that's usually reflected in a big jump in the share price. And there you go, there it is. If I'm going to be holding a stock for years, like Tesla, I'm trying to do a 10-year hold, I like to pay attention to debt versus cash. And that's particularly important in a biotech or a company that's losing money. See how much cash they have on hand and how soon they're going to have to raise money by issuing more shares and diluting the shares that are currently out there. But as Minervini says over and over again, the fundamentals are just the icing on the cake. Some of the biggest moves come from stocks that have terrible fundamentals, and then eventually they reveal better fundamentals. And if you think about Amazon, it was losing money for years and years, and the stock was going up dramatically for years and years. So don't get too hung up on fundamentals. If you're going to hold a company for more than a quarter, then I would do a deep dive on the fundamentals. Otherwise, if you're just going to hold it a few weeks to a couple months, figure out when that earnings date is, the next one. Figure out if any news releases are coming. And other than that, you can just trade on technicals. Now, the other two other areas I like to do fundamental research is one, of course, the website. Just go through and work through the website, learn all you can about the company. And the jockey, the winningest horses often win. They win. They're a good horse, but it's because of the jockey, right? You know that from watching Seabiscuit, right? And in this case, good old Jensen, what is his name? Jensen Hong? I'm embarrassed to tell you, I don't really know that. Study up on the CEO. Now, the other thing, let me pause this, is I am partnered with Seeking Alpha, and I'm not just pumping this. I've been a member of Seeking Alpha, I don't even know, 20 years or something. There's a free version and a premium version. The free version, you can have a sample portfolio and read maybe 1 or 2 articles a day. The premium version, which is the one I have, you can read unlimited articles a day. I have a link in my description below, and if you do subscribe, I'll get a little, a little stipend. But here's what I'm trying to say. Let's say we're researching NVIDIA. We're trying to figure out, should I try to hold this and pass it on to my grandchildren, or should I just try to hold it for 20% and get out? So then what I do, I type in the symbol, and I read the news articles over here, and here's articles by analysts, and I just start reading them. And when I say read them, I mean skim them. So I read the bullet points here in the summary, and I come down, I read the conclusion, and I just read a whole bunch of them. And after you've been on Seeking Alpha for a few years, you figure out which analysts are better than others and which ones you can really rely on. And then you can also read earnings call transcripts right here. And what I like to read most is the question and answer session. You learn all sorts of interesting things that aren't in the press release. We got to move to the next question. In summary, I just look at those 3. I do that, but the fundamentals are the icing on the cake. Let the chart tell you when to buy and when to sell. The fundamentals just help you with the amount of conviction that you're going to have in your holding. Okay, JJ said, glad you had fun, Joe. I was just in California. Hollywood Beach, the Channel Islands. I escaped just before the hurricane. Glad you had fun. Would love some demonstrations of head and shoulders patterns. They aren't easily identified to my eyes. Okay, so head and shoulders patterns. There are tops, head and shoulder tops, head and shoulders bottoms. Honestly, they're pretty easy to identify it once you get used to it. And the big thing about them is the greater the time span of the pattern, the more significant it is. You can find these head and shoulders that develop over a few days or a few weeks, even over a few minutes on a daily chart, but they aren't really significant. If they're really small, if they're only over a few weeks, they're not very significant. It's when they develop over a few months that they really tend to be really quite reliable, honestly. Let me show you a couple that come to mind. All right, I made a video on Microsoft making a head and shoulders top at the end of 2021, and I got a bunch of flack for it. Everybody was like, yeah, right, Microsoft will never go down or whatever. So, but let me just draw it in for you and you will see it. Okay, so here's Microsoft 4-year chart. All right, so head and shoulders top, you want to have a long prior uptrend, and then you look for a shoulder. Here's your left shoulder, and then you look for a head, and then you look for a right shoulder. Now this is imperfect. The right shoulder ideally droops a little bit below the left shoulder, and this one is actually above it. When you see this starting to form, when it gets about here, you draw a line across the neckline like so, and then when if the right shoulder rolls over, sure enough it did, when it breaks the neckline, then you sell. So you would sell right there. So you would have sold at 275, and it came all the way down to 210. This is a pretty significant one because look at August, September, October, November, December, January, February, March, April. It occurred over a bunch of months. Now, you see this formation all the time. It's very common. The smaller ones are not as significant. So look, here, and let me get out my eraser 1 second. Here is another one. Let's go green, all right? So look, here's another one right here. This is a head and shoulders bottom. Shoulder, head, shoulder. But the amount of time is much shorter. You draw your line across the neckline. In this case, you would, why is this pen is too fat, thick. And you would go long right here. But, let me erase all this nonsense. Because it's such a small pattern, it's not as apt to be powerful. And see how this uptrend was coming into a downtrending 200-day moving average? When the moving average is downtrending, the first time the stock touches it, it's most likely to bounce off and retest. And in this instance, it didn't just retest, it undercut. We really needed to see the 200-day flatten out before the new uptrend started. Let's look for some more. Okay, let me show you one more head and shoulder top and one more head and shoulder bottom. I saw this one coming in Palantir, and even though people were pumping the heck out of it in 2021 after its meteoric rise, I really saw this as a signal to get out. Okay, so here's Palantir. This was back in 2021. You had this little IPO base, kind of a cup. Let's draw this in for fun. Cup, high handle, breakout. That's where you buy. Ran up spectacularly, but now look. Left shoulder. Here's your head. Here's your right shoulder. And see how it sagged like that? Now, a lot of times you get a complex formation. You'll get more than one left shoulder, more than one right shoulder. This actually has two right shoulders. But again, you draw a line across the neckline, and it's a bit of an art, not a science, but you draw a line across the neckline when you see that shoulder start to roll over. In this case, you would have sold right there, and certainly it messed around for a while, but eventually it broke way down. Let's go back to the chart here. Ultimately, Palantir broke, so you would have gotten out at about 23, and it came all the way down to about 5. So you do the math on that one. That would have saved you a lot of money. Let's find a head and shoulders bottom. Okay, here's a great head and shoulders pattern. Inverted head and shoulders bottom if you prefer. So let's look at, one sec. Okay, here's one in Amazon for you. So you got a prior downtrend, and then you got a left shoulder here. Here's your head. Here is your right shoulder. Draw a line across the neckline. Now this is always subjective. Here's my line. Drawing it right there. Buy when it breaks out above the neckline. You buy it right here. You run up. And this is a fractal. A lot of times a head and shoulders bottom will form, and then it will build into a bigger pattern. In this case, cup with handle. Cup, imperfect handle. Big caps like Amazon are a little more random walky, and the patterns they make are not as attractive as small and mid cap patterns, but they certainly still work for, in general. They definitely help you predict price movement. Okay, I could point out head and shoulders all day, but we need to get some other questions, don't we? Okay, and then JJ, you can always Google image these things. Head and shoulder patterns. Here's what it should look like. And here are all sorts of examples of head and shoulders and reverse head and shoulders. When I was trying to show you this, I typed in head and shoulders and look what I got. The shampoo. That's pretty funny. Let's see, Caleb, would you look to play a quick swing trade on any type of bounce, or is that too short a time frame for what you prefer to do? Would you rather let the bounce happen and watch for new short sell setups? We were talking about the market the market bounce. We were talking right here when the market was just starting to bounce. But Caleb, what I do personally is I try to do 10 to 15% swing trades, and then sometimes I let these trades turn into longer term investments. But it doesn't really matter so much what I do. I guess you need to decide what strategy you want to become expert at. Do you want to try really quick multi-day or even a multi-hour swing trades? Or do you want to try to do what I do, which I just explained? Or do you want to try to be a value guy and hold for years? It doesn't really matter too much. My strategy, you need to develop your own strategy. I'm not sure if I answered the question there, but that's the best I can do for you. But if you were talking about this bounce specifically, yeah, I did play a couple little bounces and I did net some little 5 and 10% gains. But I'm expecting the market, what is this? The NASDAQ. I think the bounce is done and now it comes down and at least tests, probably undercuts this low, probably runs down here near the 200-day. And then, so I will be in cash and or short most things and then look to go long when we get down here or flatten out in some. And then Caleb also wanted my opinion on DUST, D-U-S-T. He was holding a position up 20%, stop loss is split in two, with a half trailing very closely under Friday's green candle. This was 4 days ago. And the other $1 below. All right, so let's just a sec. Okay, so looking at this is gold miner index. You got a prior downtrend, and you actually have a head and shoulders bottom developing here. You got a shoulder, you got a head, you got another shoulder, and I'm not sure where you bought, but you were up 20% to right here, and you had your stop right. You had one stop here and another stop $1 or so beneath it. When the 200-day moving average is in a downtrend like this, that means that there's a whole bunch of supply to the left. If we zoom out, you can really see all of these trapped buyers and potential supply. So that indicates you're going to want to do a really quick swing trade. So I personally would not have been in this one at all with the 200-day pointing so far down. But I think what you may have done is there's a little tiny cup with handle here. Here's your cup. Here's your handle. So you could have bought the breakout right here as it broke above the 200-day, and then you get your 10%. I guess you got 20% here. Let's see. Oh, that's only 10%. I don't know. Maybe you bought it. Maybe you bought a cheat right there. But in any case, I would have bought it right here and taken my 10%, gotten the heck out of Dodge. I would not try to hold this for a longer move until it was in an established uptrend where the 50-day and the 200-day are pointed up. Okay, let's see then on Twitter, Lee Ann, one of my earliest Patreon members, asked, how does 𝗕𝗫𝗄 look to you head and shoulders with handle de-risked after earnings? Okay, so here's the chart. Here's earnings. See this big red bar? So here's earnings. So yeah, you are de-risked after earnings, and you do see a head and shoulders consolidation, although technically the head and shoulders is traditionally a bottoming peg comes after a downtrend. So here's your downtrend, shoulder, head, shoulder. But it is definitely functioning as a consolidation. But here's the problem. Regardless of what you call this, you just have a ton of supply to the left. All this immediate trapped buyers, all of this immediate trapped buyers, all of this less immediate, all of these less immediate trapped buyers, all of this is supply that could potentially come to market and keep the stock from going up as big and small holders liquidate those shares because they're stuck. They are underwater. So in this market, I would not touch this thing until you get over most of the supply. Why is my line not drawing? There you go. I don't know why I was having the problem. So draw yourself a line, get above most of the supply right there. Now, if it gave you a really tight ledge for a while and then broke out, then you can do a cheat of sorts, but right now this isn't giving you any sort of cheat. Let me show you a cheat. I was just looking at Uber today. Let's see. So you're starting to get a little bit of a base here. See this nice tight pivot? We could cheat now. In fact, you could have cheated right here. Put your stop down here. Yeah, you have some immediate supply, but you've got a little area to control your risk reward. And see how this is just one little block of a week or two versus IMCR doesn't have a week or two. It's got months of supply. So yeah, right now I don't like it till you get above 66. Okay, Miko with some questions here. When Minervini has many pilot positions and every position is doing well, how and when does he trim the positions? So he just lets the stock be his guide. In the heart of the bull market, so to speak, he likes to have 5 to 10 really big positions. But in early bull market, for example, in early 2023, he had on a bunch of pilot positions, and then you just weed them out. You get stopped out of some that go up 10% and start to roll over. You can weed those out. You don't need to be in a hurry to weed out all your pilot positions, and then hopefully some of those you can develop into big core positions. But yeah, then you want to keep the fastest moving stocks and sell the slowest. If you have too many open stocks in a bull market, even if they're all going up, you can drop the laggards, right? Because you want to be in the strongest, the leaders, so to speak. Okay, then you said when he trades only for like 8 to 20% moves, he can't really build his position, so he has to buy larger positions at once, or what? Or does he take some profits at a certain gain, leave the rest open and wait for a new base? Okay, so I got an answer for you. So what he does is he trades around. Some things he just does a little swing trade, but a lot of times he will trade around a position. So let's say, and this is hypothetical, I don't know that he really did this, I don't think he did, but let's say he was trading NVIDIA. So he would buy it here on this little breakout, and then it pulled back and bounced. This is a pullback buy, so he would add another little piece right there, tightened up, improved further. This is called a cap. Could buy some more right there, and then it ran up, gapped up out of earnings. Then he would take some off. Let's say he would take off half here, and then he'd wait for it to set up again. So he's waiting for it to set up, and then it gives you a nice little tradable pivot, and then you could put some on, or he would put some on again right here. Then when it undercut the 50-day, he would sell some off. He probably would have sold all of it right there. So he trades around a core position on a lot of his longer term trades. And he's saying the hardest part is I seem to buy right, but I don't know when to add. And when I add, the move is probably already almost over, and then I have to start from scratch. I get stopped out. Yeah, managing the trade is by far the hardest part. Anybody can learn pretty quickly proper buy points, but it's figuring out managing the trade, manipulating your stop, figuring out when to add, when to reduce. That's the art, and that takes years of experience and training, but that's our edge. Because it's such a difficult art to learn, everybody can't just do this, and that enables the people willing to do the work to do really well, and that prevents the accountants from ruling the world by just buying stocks off of numbers alone. Yeah, Miko's in Finland, by the way. Don't know if we should wait on the sidelines or what. So like I said, I am pretty much in cash now, and I'm going to wait until the market comes in near the 200-day. I was showing you that on the NASDAQ. Yeah, so here's the S&P 500. I'm in cash mostly, and I'm got some shorts on, etc. I'm going to wait for it to retest here, and then break above the 50-day, but I expect it's going to undercut and probably come down close to the 200-day, both in the S&P 500 and the NASDAQ. And then when we see breadth and so forth improve, then I will get aggressive. Okay, the last thing I wanted to do here is Matt was asking my opinion on VRT. He's building a software tool and the chart popped up here. Vertiv Holdings. Let's just take a look at this really quick. Has a really strong relative strength of 99%. Okay, so let's look at both sides of the coin here. Here's VRT. Here is the 5-year chart. What does this company do? Hold on a second. VRT, manufactures and services digital infrastructure technology. So it's electrical power company and has good fundamentals. So on the good side, on the plus side, we kind of see the fulfillment of a huge cup with handle, a multi-year. Here's your cup, truncated little handle, blast off on earnings. So we could call this, I mean, here's your primary base, but we could start over and call this the beginning of stage 2. So from this perspective, it's just getting started. On the negative side, if you look at it more myopically on the 1-year chart, first of all, we got to remember that the market is really poor right now. So this thing is going to have some heavy gravity on it. And if you look, the spot to buy this thing was way down here. So you've got kind of a little Eve base here, a little bit of a handle. Minervini would do a half position right there. And then when it broke out, he would probably put on the other half, although he probably wouldn't buy right before earnings. So certainly that would have been your ideal buy point right there. And then on this huge breakaway gap, I don't like to chase gaps, but you can always put a stop at the low of the day. And in a strong bull market, which it was strong in early June, you've got probably over a 50% chance that that stop is going to hold up. Certainly did here. But so here you've got a stock that's run up. This thing's up 130%. It's really extended. I would like, see, here's the 50-day. See how high it is above the 50-day. Because of the weak market, I personally would pass on this until it oscillates and sags down and gets close to its 50-day again. So assuming that, the market is weak for a few weeks, this should move sideways or even come down, and the 50-day will catch up, and it'll make some sort of a better base for us here. It might just go, and if it just goes, personally, I would just watch it go. Okay, I think I'm going to wrap it up here. Thanks for your questions, Patreon members. If you're interested in being a Patreon member, I show my portfolio and focus list every weekend and do some blog posts and stuff during the week. Link in the description. I hope you learned something today. Let me know if you have any thoughts or comments. I'll put out another one of these. I can't do it every week. I'm just so busy, but I'll try to do it, I don't know, every other week or so. All right. See you, everybody.